Welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points, which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
We're restructuring for agility. Agility, in this context, means there will be fewer of you and the same amount of work. Every war ends with a treaty explaining what both sides wanted. You'll notice they had this information going in. Supply chain issues. Demand was always there. Supply was always somewhere. The chain, apparently, was the optimistic part. We're a unicorn. A billion-dollar company that has never made a profit is not a unicorn. It is a very expensive hypothesis. Busy is not an achievement. It's a scheduling problem wearing a medal.
Silicon just outbid centuries of finance. Taiwan has leapfrogged United Kingdom in market capitalization, and it's not even close to subtle. This isn't broad growth, it's a semiconductor rocket. Taiwan Semiconductor Manufacturing Company alone is basically carrying the index like a one-stock ETF, up nearly 7x since 2020. AI demand did not lift all boats, it built one massive aircraft carrier. Meanwhile, the UK market still hovering around levels last seen when smartphones had home buttons. Capital flows are following the chips and not tradition. The dollar is not fading, it's quietly tightening its grip. Swift data shows it just hit a record 51.1% share of global payments. That's not decline, that's market share flexing. Here's the irony. The more the world talks about de-dollarization, the more it builds systems that still run on dollars. Energy trade, dollar. Sanctions compliance, dollar. Global fear trades, definitely dollar. It's less a monopoly being challenged more a network effect getting stronger. You don't exit the system, you plug deeper into it. De-dollarization is real, but right now it's more ambition than execution. Zoom out and the pattern looks less like a mastermind and more like a system under stress. 11 incidents, 20 days, but 3 very different buckets. War hits, old equipment failing, and a murky middle still under investigation. The easy narrative is coordination. The harder truth, fragility. Aging infrastructure, operational shortcuts, and geopolitical tension are colliding at the worst possible time. Markets love a villain, but this isn't a movie. It's entropy with a supply chain. And that's more dangerous, because you can sanction a country, but you cannot sanction wear and tear. Indian elections come with manifestos and balance sheets. One candidate tops 5,800 crores, while others declare assets that barely buy a second-hand scooter. Same ballot, very different bank accounts. The distribution isn't just wide, it's a canyon. And it raises an awkward question. Is political competition becoming capital intensive? Then there's the other stat, 58% constituencies tagged red alert, where multiple candidates face criminal cases. That's not a fringe risk, that's system-wide. Money shapes access, risk shapes outcomes. Put them together and you don't just get elections, you get a high-stakes portfolio. What started as an equity story is now a credit story. Loans to SaaS firms did not just grow, they went from $8 billion to $500 billion. That's not expansion, that's a leverage glow up. Here's a catch. When software stocks wobble, private credit doesn't sit it out. BDCs with higher SaaS exposure are already taking the bigger hits. Correlation isn't a bug, it's a feature. This is how cycles mature. First, equity inflates the narrative, then credits fund it. And finally, both correct together. The risk isn't just valuation anymore, it's funding dependency. When capital gets selective, recurring revenue suddenly means recurring scrutiny. Mutual funds are sending mixed signals, and it's loud. Cash levels range from 1% to 21%. That's not a consensus, that's a disagreement in real time. Some AMCs are holding cash like a monsoon is coming, waiting for better entry points, bracing for volatility. Others are nearly fully invested, basically saying timing is overrated, compounding is not. The split tells you one thing, visibility is low. When the smartest money cannot agree, it usually means markets are at an inflection, not a trend. High cash isn't bearish, it's optionality. Low cash isn't reckless, it's conviction. The real question is which one gets paid.